Thank you all for tuning in. Now, I can't promise you the outcome that you're gonna get from watching this, but what I can tell you, if you apply what you're about to learn, this will change your financial future. If you're here, it's probably because you're ready for change. And what you're gonna learn in tonight's training will do just that. So if taking back control of your money isn't enough to keep you glued to this screen for the next 90 minutes, I think it's time to reassess your priorities. And tonight, we've got a special guest. My good friend Brian is gonna be doing the training, and here's what you can expect to learn. Number one, you're gonna learn how to take back control of your money. And you're gonna do that by learning how to be the bank. Number two, you're gonna learn how to build wealth through your own debts and expenses. And you can do that without working harder, without working longer, and without taking on any additional risk. And number three, you're gonna learn how to get all the money back for every single car you will ever buy, drive, and own. That's exactly what you're gonna learn in tonight's training, so get ready, get set, let's go.
Take back control.
Tuesday night.
Tuesday?
Good morning, good afternoon, good evening, depends on where you guys are at. All right, so a couple of things before we get rolling. So as we go through this presentation, I keep it pretty interactive. So ask questions. I will stop and answer questions, go through anything you have, make sure you guys understand what I'm talking about as we go through this. So don't hesitate to put questions in the Q&A box or the chat box, all that kind of stuff. And also, we do have quite a few existing members or clients on this presentation that can also answer questions if they have any experience with what you're asking. So keep that in mind. This is interactive, right? It's not just me sitting here talking. I like the feedback. So keep that in mind as we go through this. All right, let's go ahead and get rolling. So once again, everybody, I'm Brian Fouts. I'll explain who I am here in a little bit, but before we get rolling, I want to ask everybody here a quick question. And that question is this: what in life should you control, or what in life should you want to control? Now, there's three things that I talk about mainly, and a lot of you have heard this before, but if you haven't heard it before, what do you think in life that you should want to control? What are like three things or one thing that you think everybody wants to, but doesn't always control? Anybody have any time? So Dex says time. Ophoria says my health. Yep, those are some good ones. Shane says money, time, and health. Yeah, so mindset, money. Yep, time and money. So that's the two big ones. The two big ones are money. Now, money is one of those things that, by the way, money is just a tool. It's just a resource for getting the things that we do want. And how do we attain money? Well, we give things of value. We trade things of value. That's really what I would say when it comes to money. How do you attain that? But the second thing that we all want to control is, of course, time. Now, when you think about time and money, really, which one of those two things do you want to control first to control the other one? Now, my opinion is money. If you can control money, you can control time. That makes sense? Yes? Now, do we want to control time and money? Yes, right? We want to control these things. But unfortunately, what a lot of us do is we trade time for money, which is the opposite of really what we want to do. We want to have money to control time, but we're doing the opposite. Now, why are we doing that? Well, think about this. Time is the most valuable asset that we have. And that is why somebody is willing to pay us for that time, because it is valuable to them. And they know they're going to make more money off of your time than they're paying you. So let that sink in for a second, right? They're going to pay you money, maybe a lot for your time, but they're going to make more off of it than they're going to pay you. So that's why time and money are so powerful. But the one thing that you've got to control before time or money, in my opinion, is your mindset. Your knowledge. If you don't control your mindset, it'll be controlled for you, by the way. And especially when you're young, of course. But if you can't control your mindset, it's very hard to control your time and your money. So as we go through this presentation, we're going to be talking about some mindset things. We're going to be challenging our mindset around money, because if you want to do these things, this strategy can help you get to that point. And by the way, I'm at my house right now. I have a home office. I've worked from wherever I've been at for the last, 10 years, because I control both time and money, but I had to control my mindset first. Okay. And it's beautiful. Like, I'm going to go fishing later on today or do whatever I want with my kids, because I've taken control of my mindset first, and then my money, and then my time. So there you go. All right. Now I want to share this quote with you. This quote is by Will Rogers. And it says that the problem in America isn't so much what people don't know, it's what people think they know that just ain't so. Now, that's a pretty interesting quote. We love it. And I also will explain that quote again at the very end of the presentation because it kind of comes full circle, but it's a great quote right there. All right. So I want you to think about this. Now, a lot of you have heard about this, but this is just something that really hits home. Okay. So I want you to imagine that you take 100 people, they're 18-year-old kids, by the way, 18-year-olds, and you put them all into a room and you ask every single one of these kids that are 18 years old, where are they going to be at the age of retirement? Okay. Are you going to be successful or poor? Well, of course, they're all going to say, I'm going to be successful, a millionaire, a billionaire, wildly free, all that kind of stuff. But, excuse me, here's the fact. Only 5% or 5 out of 100 of those kids at the age of retirement, like say 65, will be financially secure. Not free, by the way, financially secure. And that's kind of mind blowing when you think about where we live. North America, we live in a place of abundance, right? There's so much stuff here. There's so much opportunity, right? But yet only five people are going to be financially secure at retirement. So let me ask you all a question. Do you want to be one of those 5 people? Give me a Y, give me a 1, give me a yes in the chat box if you want to be one of those 5%. Okay, the 5 people. Yes, of course we want to be that, right? Yeah, French, yeah, exactly. That's what we want to be. So yes, absolutely. But here's the fact, right? As I said, and it comes, by the way, from the Social Security Administration. They actually are the ones that say this, that only 5 out of 100 are secure. But how do you be one of those 5%? Well, it's the mindset, right? It's controlling your time and your money. And also this concept we're going to be talking about here today is one of the ways that you can get to that point. Because if you look at the 5% of those people, a lot of them are using this strategy. Okay. All right. Now, who am I? Okay, real quick, I'm not going to spend a lot of time here. My name is Brian Fouts. I actually got my start in life the traditional way, but I went to school, got a degree in construction management and business from Washington State University. Go Cougs. I know Brian from Oregon knows what I'm talking about. That has been gathering dust for over 10 years now. I haven't used it in a long time, but that was my experience, right? I went and did that. That's what I was told. But my journey was the hard way, and maybe some of you can relate to this. Well, what's that? Okay, I was raised lower class, great upbringing, nothing bad there. My parents are still together, right? But I was raised lower income, never talked about money, never even really knew how money worked. I just didn't really think about it, and then nobody talked about it in my household. Okay, but I was told to follow that traditional path: go to school, get a job, at least try to get good grades. I did get okay grades, but do that traditional thing in life. And then I got that 401k, I got that career in corporate America, was doing everything that I thought I was supposed to do. I had the house, the growing family, with the mortgage, with the car loans, with the credit card debts, all of that stuff, right? And I was being told by people around me, oh man, you're living the American dream. Really? For me internally, it felt like the American nightmare because I was like, I did not like my job. I didn't like what I was doing. I felt like I was always drowning in debt. Didn't really have enough money to do the things that I wanted to do, but I was being told I was successful. It's kind of strange. And then I was at a doctor's office, and you guys have heard the story some of you before, but I picked up this magazine. Remember those coffee tables with the magazines they had? Now it's just everybody's on their cell phone. But I picked up this article, and it talked about how wealthy people or millionaires know their net worth. Well, guess who didn't know their net worth? This guy right here. I didn't know it. So I went home, did the paperwork, did the math right there. And that's what my net worth was. It was negative. After over 10 years in corporate America, I had a negative net worth. And it was not going to get better. And I was like, this is not cool. I don't understand what's going on. I was like, what the heck is going on, right? And then something happened, a kind of a quick story. This is a personal side of it. Because a lot of us have these epiphanies in life. And this was my kind of epiphany. My grandfather, loved by the community. He was a coach and a teacher at the local high school. He taught his son, my dad, he taught my brother. And then he was working towards retirement. He was all excited about retirement. He was going to go travel around the West Coast, going to sporting events with his wife, my grandmother. And he did that right before I graduated high school, approximately. He did that and did that for, I don't know, a few years. And then he got sick. He had to go on dialysis. So he's doing that all the time, got leukemia, got Parkinson's, and then passed away. And he passed away at a fairly young age, by the way, comparatively. And he never really got to live all of that stuff he wanted to do in retirement. And remember, he gave me a piece of advice. He told me, he goes, live your life now. Go live your life now. Do everything you can to do it now. And I was grateful that he shared that because it kind of made an impact. And it told me that, hey, if I want to have a different result than what he had, I got to do something different. So that's what I did. I left my career in construction, went into real estate, went into private investing, came across this concept during that journey. And that's been my life ever since. And so I've done a lot of stuff, and everybody can say anything on the internet. So I've had some good successes. This was one of my businesses in the middle of COVID, by the way, 2021. We did over 2 million in revenue, mainly through the concept I'm talking about here today. It was one of the things that led to this business growing. It was an Inc. 5000 business, a lot of fun experiences in life. I love experiences. It's time, right? I love to control time. Money, fine, yes, but I love time. And so I've been able to do a lot of fun things with my kids that I never could have done when I was a kid. I love cars, if you guys can't tell. The one in the lower left is my current one. It's a Mercury Cougar. I've had a Cobra, all sorts of things like that. But I love to have experiences because I control time. And one of my true joys in life is sharing some of those lessons learned with others. So that right here, I'm at a mastermind group sharing this concept, by the way, that I'm gonna share with you here today. I love talking about it. You guys can't tell, I talk pretty fast when I get excited, so I'm gonna try to slow it down a little bit, but I've had a blast just helping other people learn this concept in my life. So let's get into it. Now, I want you to understand one thing. Yeah, the old Cougar, it's a 67, by the way, Beth. It's I restored it from the ground up, even painted it myself. Probably never do that again, but I love that car. So yeah, it's in my garage right now. But anyways, so I want you to understand one thing. This concept, the infinite banking concept, it is not a new concept. In fact, this gentleman, Robert Kiyosaki, Rich Dad Poor Dad, you may have heard of him. He talks about it in his book, Second Chance. And one of my businesses used a lot of his advisors as my content creators. And so I know his advisors personally, a few of them. And one of them was my mentor with infinite banking. So obviously there's a direct connection on to how Robert knows about it because his mentor was also mine for this content, or one of the guys that taught it to him. Tony Robbins, I've been to a lot of his events, and he talks about it in his book, Money, Master the Game. Great book as well. And then, of course, the foundational book around this concept is Becoming Your Own Banker, Unlock the Infinite Banking Concept by R. Nelson Nash. He's the gentleman that mainly popularized this concept. And then, of course, one of my mentors and friends, Chris Naugle and Brent Kessler, Mapping Out the Millionaire Mysteries, a book they wrote here a while back. And then Chris also has the Private Money Guide. If any of you want those bottom two books and some other resources, the PDFs of those electronically, I'll put in my email address and my personal call link here down the road so you guys can grab those. So by the way, in this presentation, there's nothing to purchase. There's nothing I'm selling, nothing like that. But if you want to talk to me about this, that's the opportunity there. But if you guys want those books, let me know down the road. I'll put my email address in the chat box. You can send it out or reach out to me and I'll get them over to you. All right. Now, who has used this concept? So we talked about who those guys are that have written about it in their books, but who's used it? So Jim Harbaugh, he was one of the top paid college football coaches, and he was actually paid, if you can see it right down here, right here, where's it at? Right there. He was paid through this concept. And how they did it is pretty interesting. I'm not going to get into it right now, but they used this concept to pay him his compensation, or one of his compensations. This gentleman, he probably doesn't remember who he is. I hope he does, but his name is Joe Biden. Probably heard about him before. So he has 6 policies. He has 6 of these things, and of course got them a while back, and his wife talked about him as well. But yeah, he uses the same concept. Gee, I wonder how many other politicians use this concept. And I'll talk about why they do it down the road. It's pretty incredible what they do and why they do it. Walt Disney. So he could not get traditional financing from a traditional bank to start Disneyland. So he used policy cash value to start Disneyland. And so without this concept, the infinite banking concept, we probably would not have Disneyland as we currently know it. Kind of cool. Ray Kroc, so McDonald's. So when Ray Kroc was taking over McDonald's, for the first 8 years, he was maintaining the salaries while growing the business through this concept. So without this concept of him becoming his own bank, per se, we might not have McDonald's as we currently know it. Okay? The Pampered Chef, she borrowed from a policy to actually create the Pampered Chef many years ago, 2002. And then Warren Buffett, of course, acquired it for quite a bit of money, billions of dollars. Pretty nuts. And then, of course, lots of families, wealthy families, and have done this over the years. JPs, Morgans, Chases, Vanderbilts, Rockefellers, and they're using this concept. And in fact, a quick little story here. I was actually doing a presentation. You saw me doing one of those things in front of that group, that video. I was doing that in front of a group, and there was a very successful person in the room. He was the first shark on the show Shark Tank. You guys may have heard of that show, Shark Tank. He was the first one. And after I did a presentation, I was talking about how, during the presentation, I was saying how wealthy people use this concept to create generational wealth, guaranteed and tax-free. And after the presentation, he came up to me and said, "You're right. That's exactly what I'm doing." So it's kind of cool to have someone actually tell me that's what I'm doing. It's kind of cool. All right. So what will infinite banking do for you? So I want to quickly share with you some of the things that this concept can do for you. So one, it creates guaranteed generational wealth, tax-free, by the way, day one. Not year 40, not year 30, not year 5, but day one, it's created generational wealth, tax-free, and guaranteed. It allows your money to grow uninterrupted and compounding for the rest of your life with guarantees. I love guarantees, by the way. You can't, I love that word, but I don't know of any other concept that I've come across that does this right here, that allows your money to grow uninterrupted, compounded for the rest of your life while doing all of these things together. Takes control of your money away from the big banks, away from Wall Street, and puts that control where? Into your hands. Remember that slide? What do you want to control? Those three things. Well, this takes control of the money away from them and puts it into your hands. That's a big deal when it comes to building wealth and building that financial freedom in life. You got to have that control. It protects your money from lawsuits, from bankruptcy, from divorce, and creditors in most states, by the way. So it protects your money. So remember how I said, why do politicians do this? Well, it privatizes your money and it protects it. So do some people want to privatize their money, take it away from the public's view? Politicians. Yeah, so this is one way that they can do that, and you can as well. And then, of course, it allows you to become the bank for things that you may normally use a bank for, things like real estate, college, cars, homes, investments, retirements, all that kind of stuff, while still having all the benefits listed above. So what infinite banking does is not just one thing or two things. It does all of these things at the same time. So who would like to have all of these things in your life at the same time? Yes, one in the chat box. Does that make sense? That you can do all of these, not one or the other, but all of them at the same time. Okay, that makes sense. Yeah, Shane says guaranteed compounding growth is amazing. Yeah, the nerd wallet calculator. Yeah, he probably, yeah, exactly. But yes, this makes a lot of sense when you start to see, okay, it's not just one thing or another, it's all of these things. Okay, most concepts, by the way, they only do like one thing or two things. This does all of these. Okay, so now I'm not going to tell you to take notes. You guys can if you want, but ask questions. So feel free to use the chat box or the Q&A box if you want to ask questions, because I will answer them as I go through this. So feel free to do that. All right. Now, remember I talked about mindset. So I want to do a quick little, analogy here. So who learns quickly? Well, kids do, right? Like, remember riding a bike? When you learn how to ride a bike, you maybe don't ride a bike for 5 years, but you hop on a bike. It's pretty easy to learn it again, right? So riding a bike's pretty easy once you get it. But here's the thing. What if the bike did not work the way that you thought it would? Now, this is called the backwards bicycle. It's you can video it or Google it for a video of it. It's pretty funny. But on this bicycle, if you hop on it and you turn the handlebars to the left, the wheel goes to the right and vice versa. So the video, the guy hops on, he cannot ride this bike. He's falling over, stumbling, cannot ride this thing at all because his mind, what he's learned about a bicycle, it doesn't make sense with a backwards bicycle. Okay. So, but what happens over time? Well, eventually he learns how to ride the backwards bicycle. But guess what happens when he tries to get on a regular bicycle? He cannot ride the regular one anymore. So why am I saying this? It's the same thing around money. So we're taught things around money, right, that might not be right. And once you learn how it really works, which is what we're going to be talking about here, it's very hard to go back to the old way or the regular bicycle, the old way of thinking about money. So I want you to keep an open mind, okay, when it comes to this concept, because one of the things we're going to be talking about here is, where does your money go first? If it's going out to credit card companies, car loans, etc., other debts, that money is going to somebody else first and not you first. So once again, where your money goes first is very important. All right, so some things we want to make sure we're clear on. So why aren't more people successful in life? So let's talk about money, the mysteries of money. So what are things that kill wealth? Taxes. Now, I don't mind paying taxes, but I'm a lot happier paying a lot less, by the way, right? So taxes kill wealth. Inflation, the kind of the hidden tax, right? Inflating of the money supply, which, by the way, is caused by two things, mainly the Federal Reserve and our banking system here in the US, and actually around the world, by the way. You've got volatility, the markets, right? You've got interest. Interest going to other people, by the way, kills wealth. Okay, mindset. So why aren't people successful when it comes to mindset? Well, they're trying to follow that status quo, fear, FOMO, fear of missing out, right? Life in general. And then, of course, what we're taught around money, what we're taught around success has a huge impact on the results that we get in life. So these are things you've got to really understand. So let's talk about some definitions here. So what is the definition of money? Okay, so as we talk about it in this concept and through this presentation, it's just a means of exchange. It's just a tool. It's all it is. Okay, it could be seashells, it could be money, doesn't really matter. Now the question is, what company uses compound interest? Banks, maybe? No, they don't really. No, they charge you compound interest sometimes, but they don't use it themselves. Okay. So there's not really a business that uses compound interest. But guess what? We can. So we're going to talk about that. Now, another question is, are your dollars worth more today or in the future? So think about that, right? If you have a dollar bill today, what can you buy, like candy wise? Can you buy a candy bar with a dollar bill today versus 20 years ago? 20 years ago, you buy 4 maybe, or 3 maybe, but today you can buy half of a candy bar, maybe if you're lucky, right? So your dollars are worth more today than they are down the road. Will taxes go up or down? Kind of a joke question. Of course, we know taxes are going to go up. They're not probably going to go down, but got to understand that taxes go up. Typically, they don't go down. Now, also, another question, would you wait to eat bread or drink milk? So what do I mean by that? Would you put a gallon of milk or some bread in the freezer and then wait 3 years or 5 years to eat it or drink it? No, even if it doubled in value, you had 2 gallons instead of 1 gallon, you probably wouldn't wait to eat that. Same with a car. Would you buy a car, put that car in the garage, and then wait 5 years to start driving that car to go to work? Well, no, that would make no sense, right? So understanding that, think about this. What do you know about your retirement account? Well, you're trading strong dollars today for weaker dollars down the road, and you're being taxed down the road. So let me ask you another question. Okay. So let's say you're a farmer and you're going to go buy some grain for $5,000, plant the grain, and then you're going to harvest it 6 months down the road for, let's say, $500,000. Would you rather pay taxes on the $5,000 on the grain or be taxed on the harvest down the road? Anybody want to answer that question? Seed or harvest? Which one would you want to be taxed on? Anybody want to answer the question? Shane says on the seed, Patrick says the seed. Exactly. Paul says the seed. Exactly. The seed. But yet a 401k or a traditional IRA is the exact opposite of that. Okay. So we wait to use our dollars down the road, but they're going to be weaker dollars and they're going to be taxed. But we don't do that with things that money buys. So here's the thing I want you to understand. We do things with money, okay, of put it into a 401k that we would not do with things that money buys. Food, a car, clothing. We don't buy those things and then wait to use them, but that's what we do with money. We put it into a 401k and then wait to use it down the road for weaker dollars. It's kind of backwards, by the way. So all of you said the seed, correct. So how do we do that? We're going to talk about that. All right, now to understand how the banks work and how banking works, I want to do a simple example of a transaction that we're typically going to be very familiar with. So let's say that you have a car that you want to go buy. Let's say the car is $25,000, and let's say that you have $25,000 of cash at your local bank, okay? And you're going to go take the cash out of the bank and go buy the car, and then you're going to take some money, call it $500 per month, and put it back into your savings account at the bank again to build that money back up again, okay? But when you go to do that, let's say the banker says, hey, wait a second, Mr. Brian, before you go and do that and take the cash out, how about this? How about I give you 4% on your money in the bank? Okay, that sounds great. And I'll give you a loan of $25,000 with your cash as the collateral. So what's that look like? So the Mr. Banker, he's going to give you 4% on your money for 60 months. And then he's going to give you a loan for $25,000 at 6%. Okay. And you're going to pay that loan back at, let's say, $483 per month. Okay. So same thing in the first scenario as paying cash and then saving that money back up again in the bank account. Same thing. Cash flow is not changing. Okay. The monthly payments are going to equal down the road, 5 years down the road, $28,999. But what is the money doing inside the bank that you're earning 4% on? Well, the future value of that is going to be $30,525. So you made $1,526, but your cash flow did not change. Yet you made money while paying 6% and earning 4%. Why is that? Because your $25,000 at 4% is compounding and going up, and the loan that you got is actually going down in value. So you're paying less interest on a smaller or decreasing balance. So the whole point here is mindset, right? You can make more earning 4% while paying 6%. Okay. So I want you to understand that. That's kind of a powerful thing right there. Now, here's what we're going to be talking about here today. So we're going to be talking about the methods. Okay. So one is going to be the machine. What is the machine that allows infinite banking to exist? Okay. Or the money multiplier method. The second thing we're going to talk about is the marathon. This is not a sprint, it is a marathon. Okay, so we want to talk about what that looks like. And the last thing we're going to talk about is everybody's favorite topic, how to become wealthy, the millionaire. How do you use this concept to build wealth? All right. So let's go through the machine. What is the machine that makes this exist? Now, I love cars, so I use cars as analogies, right? So what I want you to think about is the infinite banking concept is like a car. It's got tires, wheels, a radio, hopefully, mirrors, seats, all that kind of stuff, steering wheel. Okay. But if that car, the infinite banking concept, by the way, it doesn't have an engine, can it go down the road? No, it can't. It has to have an engine. Okay. So here's what the engine is that allows this concept to exist and to go down the road. It is nothing more than a specially designed, by the way, specially designed dividend paying permanent whole life insurance company from a mutual insurance company. But once again, not off the shelf, specially designed. Now you might be saying, well, Brian, why life insurance? I don't really need life insurance. Well, guess what? We're talking about the infinite banking concept. This just happens to be the engine that allows it to exist. Okay. All right. Bank-owned life insurance. So why do I mention this? So a lot of people don't have this kind of life insurance, but guess who does? Banks. Banks own more life insurance, whole life insurance, specially designed, by the way, than they do their buildings and real estate combined. They own a lot. You can go Google it. It's called BOLI, bank-owned life insurance. They own a ton of this stuff. Why is that? Do they know something that we don't? Absolutely. Of course they do. So why don't we do the same thing the big banks are doing with our money and just go do the same concept and be the bank ourselves? Okay. And one little kind of side story here. So I had a client, this is a few months ago, he was going to go do a presentation to a local credit union. This is kind of funny. And I can't remember what the presentation was on, something financial, of course, related. And I told him, I said, hey, I want you to do something for me. When you go to the room and you go to the presentation to these, 6 people, not a big presentation or big group, they're all the presidents, the manager, the vice president, that kind of stuff, executives. I said, I want you to ask them if they have any life insurance and who owns it. And so when he came back to me and said, hey man, I did what you said and you're right. They all said the bank that they work at owns life insurance on them. And so it's like right from the horse's mouth. So there you go. Okay. So that's the machine. Okay. Now to understand why we want to understand how this works and how banks work, we've got to understand first off, how our money flows. Okay. So I already showed you how it flows right here, right? So why now that you understand how this works, when you are the bank, not only are you the bank in this scenario, and you're also the borrower, you're both of them. You're on both sides of the equation. You're benefiting from both sides of it, not just one side, and you're in control. Okay. So that's how this can work, because now you have control on both sides. Now, to understand why you want to be the bank, let's talk about how banks actually function, how they work, because why do banks exist? Anybody want to answer that question? Why do banks exist? It's kind of a funny question. Anybody want to answer that? Why do banks exist? Taking some water here for a second. Yeah, Shane, there you go. So answer to make a spread. Yeah, to make money. Exactly. They are a business of profit. Okay, they want to make money. That's the bottom line right there. It's for profit. Okay, they're not non-for-profit, or what is that, a charity? They're for profit. So how do they do that? Okay. Well, one, it's by controlling one thing mainly, and it's money. Remember we talked about that? But whose money are they controlling? Your money. Okay. So how do they do this stuff? So let's just say that you have $100,000 and you put it on deposit at the bank, and they're going to be nice and give you 4%. Okay. 4%. Now, what is that to the bank? It's a liability. It's an asset to you because it's cash, but it is a liability to the bank. So they're not going to sit there and just do nothing. They're going to do something called fractional reserve banking, and they're going to put that money into motion. Money in motion makes money. Write that down, by the way. Okay. So what do? They lend that money right back out. Maybe it's on a home loan, mortgage, HELOC, whatever. Okay. But what's the person that actually sold you the home going to do with the proceeds? Okay. Well, they put it right back into the bank again. Okay. So what's the bank do? The same thing. They put it right back out into motion. Maybe it's on a car loan at 8%. What's the car company do? Back to the bank. What's the bank do? Back out again. Maybe it's a home remodel. What do the contractors do? Subcontractors do with the money? Right back to the bank, and so forth and so forth. Maybe the next thing you do is a debt consolidation loan at 12%. What's the credit card companies do? Right back into the bank. So the bank is putting your money into motion many, many, many times over, to the point where, hey, they're paying you 4%, but guess what? They're making 20% or more on your money, which is 500% more than they're paying you. Now, don't take my word for it. You can actually go to BauerFinancial.com and look that up. Banks make between 400 and 1,300% on the money that you leave there. Now, that being said, you might ask, well, how come banks go under or declare bankruptcy or whatever it is? Because banks do other things with money that they should not be doing, investing into other things like, securities and loans and mortgages that are bad. And so they're not very smart in some regards, and they are also over leveraged because of fractional reserve banking. And so when you have a bank run or the market changes abruptly, banks can get into big trouble. But granted, not all of them, but they're doing this kind of stuff with your money. So keep that in mind when you go and put your money in a bank. All right. Now, the last thing I want to mention here really quickly is to understand why you want to be the bank in your life. You have to understand how we spend money. How is our money flowing through our life? So let's look at how we spend money. This is kind of the average household, essentially. Okay. So let's say a dollar comes into your life every month or every week, whatever that dollar comes in. Where does it go? So for the average family, 20 cents or 20% of every dollar goes to automobiles. So think of like payments, gas, upkeep, tires, whatever. Okay. Then 30 cents of every dollar goes to housing. 40 cents of every dollar goes to everything else, travel, entertainment, food, etc. So if you understand this, that's 90 cents right there. So 90 cents of your money goes right out the door to somebody else before it goes to you. So what's left over? If you're lucky, 10%. So that's what you get, 10%. Okay. And by the way, before COVID, I think it was, oh my gosh, it was a higher number. During COVID, the savings rate went up, I think. And then I think right now it might be, I don't know what it is right now, but right after the recession, it was like 5%. So that one changes quite a bit, but that's where money going. So what I want to do now, let's flip it around. Okay. Let's start with the savings part of it. This is the opposite of what a traditional financial planner would talk to you about, by the way. So now let's look at the opposite. Okay. So let's say if we were able to move that interest that we're paying to other people into our pocket or our control. So let's look at an automobile. Of the 20 cents going to automobiles, 5 cents of that is interest. Let's recapture that back to ourselves. Okay, there we go. Housing. Okay, if 30 cents is going to housing, if you have a mortgage, about 25% of that is going to interest. So what if we recaptured that, by the way, back to ourselves? Now, by the way, if you're renting, it's zero, going back, zero to interest, and you cannot recapture that. So keep that in mind, okay? And then, as I said, 40 cents of every dollar is going to everything else, food, clothing, etc. And of that, around 5% is interest. So let's recapture that back to ourselves, okay? So now what have we done, okay? We've actually recaptured the interest back to ourselves. So you can see how when you are in control of the money and you are the bank and the interest comes back to you, essentially, you can actually build wealth because you're focusing on the saving side of it, not on the spending side. So anyways, that's just kind of something to understand is how we're taught is to do the opposite of this. We're taught to leverage and pay interest to other people, which then makes them wealthy and not us. Okay.
You ever feel like you don't have control of your real estate business or your money? That's right. The big banks and the institutions, they're in control, right? I know you felt that before. Private Money Club puts you back in the driver's seat. As members often tell us, it's a total game changer. Join the community of like-minded lenders and borrowers by going to privatemoneyclub.com and sign up.
Now, the next thing I want to show you is go through some examples of how you can use infinite banking to control different transactions in your life. So the first one is actually a car. How can you get all the money back that you'll ever pay for every car you'll ever drive and own? Now, why do I say a car? Because most of us have used a car loan before. Now, if you're an investor and doing real estate, replace a real estate asset with the car. It's the same concept, same thing, right? Okay. So let's go through a car though. And this is kind of a fun example. So now here's what we're going to see. So on the right-hand side over here, this is what is called a policy illustration or detail. So it's a tabular detail showing how much is going into the policy. Okay. Now, a few things. When you think of insurance, people think of, oh, I've got this monthly bill or monthly expense. I'm going to call it a premium deposit. Okay. Why do I say that instead of a bill? Because when you deposit into your policy, your bank, essentially, you can take money right back out. Okay. So it's a deposit. Okay. So whenever you put a premium in or you fund a policy, keep in mind what's going to happen. You'll see it right over here. You're going to incur or cash value is going to grow inside the policy. uninterrupted for the rest of your life. It's going to keep growing and growing. So as you deposit, you're going to have cash value that you can borrow back out. The next thing I'm going to mention really quickly is age. Obviously, a lot of people say, well, Brian, what if I'm 65 years old or 55 years old? I can't do this because I'm too old. Not true. Age doesn't really matter because you can do policies on other people where you are the bank and they're the insured, and you can use this the same way. So my oldest client is like 74, by the way. Keep that in mind. All right. Death benefit. You're not going to hear me talk a lot about death benefit during the first part of this because we're talking about the living benefits, not the death benefits, but the living benefits. The death benefit is a side benefit, as I call it, right? So living benefits is what we're focusing on here. All right. So let's look at this example. So in this example, get in here. So we're going to deposit into our bank $10,000 each year. Okay. You can do that. And this is just an arbitrary number. By the way, your amount could be 5,000, could be 15, could be 100. Okay. It depends on what your situation is. This is just an example of 10,000 going in, and we're going to do an annual deposit at the beginning of every year. It can be done monthly, quarterly, annually, up to you. Okay. And that's very flexible. So let's do $10,000. Okay. Now, as I said, every deposit, the cash value is going to go up. Okay. And you can borrow out the cash value. So in this example, we're going to go buy a car at the end of year 3. So at end of year 3, we take out $25,000 out of our policy. That's cash, by the way, it's cash. But since we are a responsible banker for our own banking system, we're going to pay ourselves back. All right. So what's that look like? Well, we're going to pay $500 per month or $6,000 per year back to our policy, back to our banking system. So what do the numbers look like? Okay. Well, we put in $70,000 as deposits. We put in $30,000 as loan paybacks. That's $100,000. But keep in mind, we also took out $25,000 of cash. That's cash in hand. So how much did we really put into the policy? About $75,000. And yet, if you look right here, we recaptured 91% or 91 cents of every dollar back into the policy so far. Okay. Now, this is the very, very, very conservative numbers right here. In most cases, they're a lot, the performance is crazy, but I want to be conservative here. But now let's look at years 8 through 12. This is where things get really powerful. Okay, in years 8 through 12, we're not going to put in any more deposits. You don't have to, by the way. Now, if I were you, would I do that? Yes, I would keep putting in money because the more you put in, the more you get back out, right? But in this example, we're not going to put in any more. Okay, so we're going to reduce the deposits down to 0. But we're still going to have growth of our policy. So look at this over here. See how the cash value keeps going up every year, even though we're putting in 0? That's pretty amazing. Now, in year 8, we're going to take out $25,000 and purchase a second car, maybe for our teenage kid, right? Hopefully not, but let's say we go ahead and do that. We're going to do the same thing though. We're going to pay that back with interest back to our loan, our banking system. Now, what does it look like now in years 8 through 12? Well, we put in $30,000, but we also took out $25,000 of cash. So in reality, we only put in $5,000 in years 8 through 12, but our cash value from year 7 to year 12 grew by $23,000. So once again, you put in 5 and your cash value went up by $23,000. Now, here's what I want you to understand. So if all that didn't make sense, it's fine, but here's what I want you to understand. How much did we put into this policy? $75,000 plus $5,000. That's $80,000. How much is the policy worth? How much cash value do we have that we can use? $91,000. And what else do we have? 2 cars that are 100% paid for. So who would like to do that? In most cases, we would just have the cars and that money would have gone out to somebody else. Okay. In this case, we've built wealth and we have the 2 cars. And someone says, well, Brian, but where's the $10,000 coming from? That's always a question I get. Where is the $10,000 coming from? Well, cash flow, or let's say it's going to something like maybe a 401k, and maybe you redirect that back into a policy. So it's now, instead of going to that bucket, it's going to this bucket. But this bucket can do what I just showed you. So your cash flow didn't change. You still purchased the cars, but your net worth went up, and you still have access to $91,000 to go do maybe real estate with now, or pay for a kid's college, whatever you want. It's right there. It didn't go anywhere. You still have control of it. You can still use it. That is infinite banking. Now, granted, this is a very conservative numbers right here, but that's just sort of to start to change your mindset around this. Okay. Now, there's 3 rules with infinite banking. Rule 1, Pay yourself first. So did you pay the car company first? No, you paid yourself first, and then you paid yourself back first. So the second rule is this: recapture and recycle the money through the policy, be a responsible banker, pay your loans back, and then guess what? Put that cash value to work. Use it in your life. Whether it's investing, whether it's recapturing banking functions like this one, use the cash value, okay? Excuse me. All right, so those 3 rules, once again, there are: pay yourself first. Okay, you just saw that. Pay yourself with interest. You saw that. Paying the loan back that is your loan, but you pay it back because even though you are the bank, pay yourself back. And then recycle and recapture your money. Use the cash value. Be the bank. Okay. Those are the 3 rules right there. All right. Now, if this works for a car, what else does this work for? Now, I'm going to go through other examples of investing and how to build wealth in the 3rd section, but these are kind of some of the first things. So the next thing I want to show you how you can use infinite banking is to recapture debts. So remember, one of the biggest killers of wealth is interest or debts, which is liability. So a lot of us are taught to have a lot of liabilities and not assets. So if you want to build wealth, which is, by the way, building assets, what's the first thing you want to get rid of? Liabilities, right? That makes sense? So first phase, get rid of liabilities. So we're going to go through an example. This is a fairly conservative example, but it is a real example. But I want to go through this because when you see how this works and how you can get rid of liabilities, man, this can really change your life. And Shane knows what Shane did this, by the way. I think he did this one. So, all right, this is a doctor, by the way. I think he's a dentist or a chiropractor or whatever it is. Doesn't really matter. But this person has $478,000 of debt. That's quite a bit of money, okay? Now, granted, yours could be a third of this or a half of this. Doesn't really matter. Just understand the example here. All right, total payments this person is making every year or every month is $5,777 per month, almost 70 grand per year, okay? So if you paid this off traditionally, it would take 19 years to pay this off. 19 years, a long time, by the way, okay? And that's, a lot of people do that, okay? But that steals wealth. All right, so let's look at this. So this person started up a policy of $25,000 premium deposits in the first year, okay? So once again, 25 is going in. Now, where is that money coming from? So this obviously is a doctor. He has higher income, higher cash flow. So he was depositing a bunch of money into like market funds and 401ks, things like that. And he was not happy with those results. So what he did was move some of that capital into a policy. So $25,000 annual deposits. Okay. Now within 30 days, not 3 years, by the way, within 30 days, he has access to around $14,863 of cash value in the policy. Once again, very conservative numbers. So what do? So we go to our bank, we borrow out 14,000 and change, and we pay off some of our debts. Okay, Discover card, Lowe's card, and part of the Nordstrom card. Now, I want to pause for a second, make sure you understand what happened. So we took a loan from our own bank to pay off these debts. So the debts moved into our policy. The debts are still there. It's just they're not going out to somebody else now. We now captured those things into the policy. Okay. Now what happened? Well, the monthly payment was reduced by $448 now. Okay. So that's what happened at the very beginning of year 1. Now, what does year 2 look like? Okay. In year 2, okay, we deposit another $25,000. The cash value from that deposit is now $16,571. But we've been taking that $448 every month from the prior year, and we have paid ourselves that money and captured that control. That amount is $5,374. So now, how much total cash do we have available? $21,945. So now what do we do at the beginning of year 2? We take that out, we pay out the Nordstrom card, Wells Fargo, private loan, and the BMW. All right, so that's what we did. Our monthly payments now have been reduced by $1,917. Okay. Now, year 3, same thing happens. Okay. We deposit another $25,000. Cash value jumps up by $25,000 and change. The payments that we are now paying back to ourselves of $1,917 every month equals $23,004. Total cash is now $48,000 and change. All right. So that's how much we have. So we take that out. We wipe out the BMW, West Marine, which I believe is a boat, and then part of the condo. Now our total debts outside of our policy have been reduced by $283,000. Okay. Now what do? Well, our monthly payment has dropped down to $3,677. All right. So what I want you to understand is this. How much did we put into this policy? $75,000. How much did we take out? Around $55,000. Okay. So how much is left in your policy? Is it $20,000? Nope. It's actually $75,000. You're still earning dividends on what's inside the policy. Even though you borrowed from it, the dividends are still going up and adding to the cash value. That's why your premium deposit is worth more and more every year. So that's what's happening. Pretty cool. So year 4, same thing. 25 goes in, cash value goes up by 26,000. The payments of $3,677 back to ourselves is $44,124. So total cash is 70 grand. Now, what do? Well, we borrow that and we pay off the condo. Okay. But here's the thing, because that's an amortized loan and also the house is an amortized loan, when we pay those off, it does not change the monthly payment. So in this case, the monthly payment in this year does not go down, but we still recapture that money. So in year 5, 25 goes in, cash value goes up by 27, payments back to ourselves are 44,000. So we have $71,225. So now what do? Now we wipe out the condo and a huge chunk of the house. Okay. And now our payments have gone down by $4,556. All right. Year 6. Now, year 6, this doctor did this. He goes, hey, wait a second. I'm pretty happy with this policy, but I want to do a second one because now guess what? It's been, 5 years. I've got more income. I want to put more income into a policy. So what's he do? So you can see right here in the first policy, he drops it down by $15,000. So now he's only putting in to the first policy $10,000. You have that option, by the way. So he drops it down to $10,000, but the cash value still goes up by $13,000. The second policy, this is year 1 for the second policy, puts in 25 and has access to 14,863 of cash value. Okay. So, and the payments of 456 or 4,556 back to himself equals $54,000. So now how much cash value does he have? $82,000 and change. And if you're wondering why did this go down from the previous slide, it's because he's still making that monthly payment back onto that every month. Okay. So that's why that balance went down. Okay. Some people ask that question. So now what do? Well, we take a portion of the cash value out, pay off this house. Now our debts are 0 and the monthly payments are 0. So that's year 6. Now what happens in year 7 and I think it was year 7 and 7.5 years. He takes this cash flow, puts it back into his policy, pays off that loan, and now he's got 6 figures of cash value in the policy, free and clear, 0 debt, 5,000 and change of cash flow. And now he's starting to build wealth by going from paying other people to now getting assets of the cash flow. But it only took him 7.5 years instead of 19 years. That is pretty incredible. Now, if you're saying, Brian, that sounds cool, but I have no idea what you just said or the math on that, don't worry about it. We gotcha. We actually have software that maps this out. So it's called the Debt Blaster. You can see it right here. We'll analyze different methods of paying the debts off compared to infinite banking, and we map it out for you. There's a whole schedule that shows the month by month and how you do it. So there's no guessing. There's no cost, by the way, for this kind of stuff. But yeah, we map that out for you because there's math involved, right? And so that's called our implementation agent or implementation team. So we work with you on an ongoing basis after you have a policy to use it. So, and Shane, by the way, you can see his comment there. He actually did this. He used this. So, this is stuff that we actually do for people. Okay. But pretty powerful. All right. Now let's talk about the millionaire method. This is how you start to really build wealth with infinite banking, because now the question is, well, what if I don't have any bad debt? What if I don't need a new car? Can I still benefit from privatized banking? Should I still become my own banker? And of course, the answer from us is an absolute yes, because guess what? Once you don't need that, you don't need a new car, you don't have any bad debt, that's where the fun can really begin and start to build wealth and build that legacy. So let's talk about that. So now that you have that, like that doctor has, I can't remember how much it is, a couple $100,000, $300,000 of cash value, whatever it is inside the policy, what's he do with it? Well, here's some ways that our clients do it. So real estate investors, wholesalers, flippers, buy and holds can use this. Commercial properties, apartments, builders, mobile homes, things like that. Real estate lending, private funds, lending money out to other investors. So by the way, that's kind of funny. So I'm going to show an example of this actual numbers. You'll see some real policies. But if you borrow from your policy and then lend it out to somebody else to do a real estate deal, you're the bank twice. You're borrowing from your banking strategy, and then you're being the bank to somebody else. It's kind of cool. I love that. Business owners, we have a lot of business owners that use this. I just talked to one today who has a very high revenue business, and he's looking to use this to recapture some of that business revenue and pay off some of the debts and recapture that debt back through the policy. Stocks and options traders, if that's something you do. I know some people that do they do options, and so they'll borrow from the policy, do the options, etc. Startups, and then equipment flipping. So we have people that do flipping of equipment. It's kind of fun, but yeah, so there's lots of things you can do. So what I want to show you right now, I want to show you an example of using private banking, your policy, to do private money lending. So like, let's just say private lending on a real estate transaction. All right. And this is actually a real illustration, a real policy. Okay. So this is what is called a tabular detail. And this shows you the year by year numbers. And these are all end of year numbers. Now you're going to see the cash value here and net cash value over here. So this is called the guaranteed side, the left hand. And the right-hand side is the non-guaranteed side, which is dividends. So we focus on the dividend side because that is what the insurance companies have always paid. They've always been profitable. They've never lost money. So we tend to look at the accurate side, which is this side. So in this example, let's look at year 8. Now, why do I say year 8? Well, because as these policies are in effect, the longer they're in place, the more and more efficient they become. So as they capitalize over time, it's just ridiculous. So let's look at year 8 as an example. Okay. Now keep in mind, you can do this throughout any year, but year 8 is a great kind of middle of the road time frame. Okay. So in year 8, this person's bank grew by $66,722. Okay. How much did they put in? Well, they only put in $48,593, but it grew by 66. Okay. Pretty good return. In fact, the cash on cash return, if you want to look at it that way, is 37%. Now, why is it that high? It's because we have capitalized the account in the previous year. So your dividends are coming in and getting bigger and bigger and bigger as time goes on. So these numbers just get better and better, okay? So that's what it looks like just inside the policy. But what does it look like if we were to private lend the money out? So let's just say 12% private money loan. So that's called a hard money loan or hard money rate, anywhere from 10 to 15% in most cases, so 12%. So now you're lending that money out at 12%, okay? You're already making 37% on that same money in the policy. Let's just say the rate of interest on the loan from your bank is 5%. So you're making 44% on the money, okay? Now, I've known a lot of private money lenders that are just private lending cash. So in this example, we did nothing other than where the money went first. It went through the policy first, then it went out to the strategy, okay? So the question then becomes is, would you rather make the 12% just by private lending cash or be 40 or 44% by being your own bank? It's kind of a no-brainer question, right? But this is how powerful infinite banking can be when you are in control and you are the bank. So that makes sense? So that's just one example of how to use infinite banking as a private lender and make even more money because your money is out there working for you. All right. Now, you've heard me talk about uninterrupted compound interest. So I want to give you a quick example of how this works over time. So in this example, someone's putting in a lump sum, which I'm going to talk about what that is. They're doing a 50K dump in. Then they're doing a $491 per month premium deposit or $5,895. Okay. At the end of the first year, they have around 51,000, I believe, of cash value, something like that. But look at the cash on cash return year over year. 21% year 2, year 5, 26, year 10, 54, year 20, 191. You can see how it grows. Oh, and it gets better and better year over year. Access to capital is the same thing. So how much access to capital inside the policy do you have? Well, year 2 is 121%. Year 10 is 154. Year 20 is 291%. So you can see how over time, these things just keep getting better and better and better. That is the power of uninterrupted compound interest. Just want to share that with you real quick. All right. So the millionaire method. So how do you eat an elephant? It's one bite at a time, right? You've heard that before. So the example I want to give to you is the man at the top of the mountain. So you may have heard of this analogy before, but you always see that person that is very successful, that has all the cool things, that is living life to that fullest extent at the top of the mountain. And here we are at the bottom. And we say we want to be at the top. But the problem is everybody's walking around the mountain. What did the guy at the top do? He took the first step to climb the mountain. So infinite banking is the same thing. You've got to start that climb to get to the top. If you don't do anything different, you'll be walking around the mountain for the rest of your life. If you want to be at the top, you got to start. Same with eating an elephant. If you want to eat an elephant, you've got to start. It's one bite at a time. So infinite banking is no different. Just want to make sure we're clear on that. Okay, so if this thing works for debts and expenses, vacations, homes, everything else, it can do lots of other things, by the way. So it can work for taxes. A lot of us do taxes, but we hold the taxes in our policy, and then we pay it out at the end of the year so that we're controlling that money during the year. So that's one thing that we do. I have people that use it for vacations that are in retirement. Lots and lots of other things, by the way. Okay, I'm going to skip this slide. So when it comes to things like real estate investing, so people say, well, Brian, okay, how does this work with real estate investing or being your own bank, private lending? It's right here. We have software that does that as well. So if you have real estate deals you're doing or projects you want to do, or even equipment you want to buy for like a business, we have software that'll analyze how to use the policy effectively to do those things like real estate, private lending, paying off debt, by the way, of course, all that kind of stuff. So we actually do this in our own lives. That's why we have the software, and we actually will do it for you if you're a client. So just keep that in mind. All right. So I got more slides, but I want to make sure that I do share some of the stuff with you really quick because we're at the top of the hour. I do have some more slides that I'll share with you, but I do want to share with everybody here real quick my personal call link and also my email. So let me go ahead and put this in here. There we go. All right. So inside the chat box, I'm going to go ahead and put in my personal call link. So if you guys want to schedule a call with me to go through infinite banking, go through any questions you have, see how this can work in your life. It's a call directly with me, by the way. You can go ahead and do that. So there it is right there. And then I'm going to put in my email address. So if anybody wants to, send me an email for those resources, I think they're also in the call link, but if you want to send me an email directly for those PDFs and the PDF books that I mentioned, the resources, just send me a personal email and I'll just get it right back out to you. So there's my personal email address right there. Okay. And then right there on the screen, you can see brian.beyourownbanker.com/TBCT. That's what you need to go to if you want to schedule a call directly with me. And there's no cost. There's nothing to buy on the call, nothing like that. I'm not pitching you anything. It's just a call to really go through infinite banking, any questions you have, your situation, how it can work, that kind of stuff. Okay. All right. Now I got quite a few more slides and some things that I want to make sure that we do cover that people have questions on or make sure you want to get clarity on. So one thing I want to share though real quick though is this picture. I like this picture. So most people, if you're not in control of money, money is controlling you. So what does infinite banking allow you to do? Well, hopefully control your money. So you want to be the guy on the bottom or the guy on the top? That's an example right there, right? But I love that picture. I've used it in a lot of presentations. Kind of funny. All right. So by the way, so some things quick things we're going to cover here in the next few minutes. We didn't talk about death benefit. I'm going to cover that. We didn't talk about the loans. It's your loans. They don't have to be repaid. We're going to talk about that. The values inside the policies grow tax-free, by the way, tax-free. We don't really talk about that. And when you take loans out, those are not taxable. Yep. Yeah. Dex says, yeah, get on a call with Brian. Yeah. I don't know Dan Fouts yet. Have not found the relation yet. Working on it though. Not yet. Policies, they are exempt from judgments from liens in most states. So I can go through that with you, what that means. And you can create tax-free retirement with infinite banking. All right. Okay. So let's talk about generational wealth real quick. So I want you to look at this policy here, this one. So this is a female, age 42, putting in $20,000 per year right there for 5 years and then drops it down. So at the end of the first year, this person has put in $20,000. The death benefit is $325,000. God forbid something happens to this person in the first year. Her family, her kids, whomever is going to get 325 grand if it's the end of the year, tax-free guaranteed. That's like what? 5, 10 times the money, 6, 11 times the money almost. In year 5, she's put $100,000 in. Cash value is 99 grand. Could have been using that for whatever. And the death benefit has grown. Keep in mind, it grows over time to $483,000, almost 5 times what they put into this thing. And as this policy grows and matures, that death benefit is going to go up over time. It doesn't go down, it goes up. Okay. It goes up along with the cash value. So if we understand that one thing right there, tax-free generational wealth with guarantees, now you understand why wealthy families do this on all of their family members day one. Because they know that they put in, let's say over this generation, they put in $20 million on 10 family members over the lifetime. That's going to turn into probably $100 million tax-free guaranteed for the next generation to use. And they do this every generation. That is incredible, by the way. But it starts with the first person. It starts with you, right? It starts with the first person, but that's how that works. Okay. Policy loans. Okay, policy loans. Okay, they are guaranteed as well, by the way. Ask and you shall receive, essentially. It takes about anywhere from 2 to 4 or 5 business days typically to get the money into your hands. Loans are private, by the way. They do not go on your credit report. So think of that doctor when he was paying off all those debts. They were coming off his credit report very fast. And so we've had a lot of people that will use policies to recapture debt. Their credit score goes up or their debt goes down, and now they qualify for other types of financing. So other strategies there. The loans, you do not have to make a payment back on them. Now you should, of course, but you do not have to make a payment. There's no minimum, no maximum. Okay. Yeah, Shane says there, instant credit score increased when he started the policy because he did that. He moved the debt over. Miss a payment on your policy loan, nothing happens because there's no required payment. Okay, so keep that in mind. So you're in control. Remember control? That was the first thing I talked about. This is exactly how you control it. All right. Another question I get quite a bit is how can I fund my bank? How can I fund the policy? So it can be done monthly, quarterly, annually, right? Anyway. And you can change that, by the way, during the course of the policy. So what's the range of what you can put into a premium deposit per month or per year? Okay. The low end is around 10 times your age per month. That's minimum. Not since a recommended amount, it's just the minimum of the range. The maximum range depends on the individual and your gross revenue, gross income. Roughly 20%, 25% of your gross revenue divided by 12. So if it's $100,000 gross income, okay, 20% of that is like what? $1,600, $1,700 per month. There you go. So 20% of that is, whatever it is, 20,000 divided by 12. That's how I got to that math right there. Okay. So that's the range of what you can put in. Also, that's the first way you can fund the policy. You can capitalize the account. The second way, and you saw this on some of the illustrations, is you do what's called a dump in or a lump sum. Okay. That's typically done at the beginning of the policy, can be anything from 0 to around 7 to 8 times the premium. Okay. And that overfunds the cash value very quick, makes the policy very efficient, and you can access cash value very quick within 30 days or 30 days or minimum. Okay, so there you go right there. Now, the question I always ask people is, understanding what I just said, how do these things look down the road? Well, you already saw it, but I'm going to show you on an illustration here in a moment. But would you ever put in $1 into an ATM machine in order to get $3 back out? That'd be the magic ATM machine, right? That'd be incredible. So let me show you the magic ATM machine. Okay, so this is a policy right here, example, 32-year-old female, putting in $10,000 per year annual premium. Once again, that's just a number. But they're also doing a lump sum of $50,000 day one. So at the end of the first year, this person has put in $60,000, has access to $55,000 of that within the first year, at the end of the year. Okay. But let's look at year 2. Now they put in $10,000. Cash value went up by $10,607 at the end of year 2. Very efficient policy. But let's look at year 11. Now, as you can see, they're reducing their premiums. They can do that, by the way. You can reduce premiums over time. But look at this. They put in $3,120, but the cash value went up by $10,590, over 3 times what they put into the policy. And that's going to get better and better as time goes on. So understanding that right there is a reason why you would not want to have this in your life, right? Now, granted, you've got to qualify all the kind of stuff, but yes, this is what this thing can do. Okay, it grows and gets more and more better or more efficient over time. All right. Now, this is a Warren Buffett quote, and this is not my favorite quote, but we have it in here. But it says that poor people would just do what rich people do. They wouldn't be poor anymore. I like to say it this way. Yes, I get it. But if poor people had the knowledge of the wealthy and took action on that knowledge, they wouldn't be poor anymore. Because I'm giving you knowledge here today, but if you don't take any action on it, nothing's going to change, right? So you have to take action. Knowledge is great, but knowledge plus action is powerful. Like I always used to say, knowledge is powerful, or is power, right? You've heard it before. Knowledge is power, but knowledge plus action is powerful. Okay. Got to take action on it. All right. So another question I get is, why should I work with you, Brian? So one, I've been teaching infinite banking for actually about 9 years now. And why should I work with us, our team? So we have an entire team that works with you to set up infinite banking. We're over 40 people. Our team is one of the largest producers of infinite banking in the US. So keep that in mind. I have over 100 clients right now in underwriting, something like that right now. So quite a few in underwriting. We do provide ongoing support and services. So we help you use this thing. Not only do we build it for you and give it to you, but we also support you in how to use it ongoing. And there's no cost to you. There's no fees, nothing like that. We do not charge you anything. So keep that in mind as well. Another question I get is IUL or VUL infinite banking. I'm going to be very quick on this one. The answer is no, absolutely not. IULs and term insurance pay some of the highest commissions out there. We take a 70% cut in commission to do infinite banking. It's why a lot of people don't do it the way that we do it, because they're not willing to do that. Okay. And then our team only does infinite banking. We don't do IULs. We don't do term insurance. We all are certified by the Nelson Nass Institute for infinite banking. If you do IULs for infinite banking, you cannot be a part of it. But the reason why IULs and those things, they do not perform like they typically show you, and they are not the best vehicle, in our opinion, for infinite banking. And we will go to the mat on that one. All right, so one of the two things will happen to us in life, right? We live. So the question is, if you look at what I just showed you with infinite banking, are we better off with or without it when we're alive? And then, of course, we all know that we're probably going to die a couple hundred years from now, hopefully. But are we better off with or without infinite banking in our lives if that was to happen as well? So for me, the answer is yes on both sides of this. Okay. All right. I'm not going to go through all these slides here, but I'll just kind of share with you kind of a quick little synopsis. So when I first learned about this, I was the guy on the left. I was like, you know what? Guess what? I don't need anything. I don't need any help, etc. I don't want to go learn all this kind of stuff. I don't want to work with the best. I want to go work with my buddy. And he did set me up with a policy. It was a VUL, Variable Universal Life, and it was garbage, and it was absolutely horrible. And I learned my lesson. So I said, hey, you know what? I want to go work with the best people. So fast forward many years, Robert Kiyosaki, one of his mentors, was my mentor. I learned how this really worked. And of course, now I work with what I believe is the best team in the industry doing infinite banking. So it's always a choice, right? But my journey was to go do it alone, beat my head against the wall, learn that painful lesson. Actually, if I go back and do the math on it, by not doing it the right way the first time, I probably lost out on about $250,000 of cash value in the policies because I didn't do it the right way the first time. Pretty brutal, but yeah, that was my lesson learned right there. But group two, right? That's what I always want to be. It's that one that learns it from the best and then takes action on that. So here's the action right here. Here's the call to action for you guys. It's if you want to learn more about this or have questions, want to go through your situation with me, just hop on a call with me and we'll go and do that. Obviously, I put in my call link in the chat box, brian.beyourownbanker.com/TBCT. I'll put it in the chat box one more time. And that's pretty much it there, guys. But I like to end on this quote right here, because hopefully it makes more sense now, by Will Rogers. The problem in America isn't so much what people don't know. It's just what people think they know that just isn't so. So there you go. So guys, any questions, any thoughts, anything you always want to go over? Yeah, Shane, appreciate that. And by the way, yeah, so Shane and Dex, both of you, if you can reach out to me, as I said here, in a couple of weeks, we're going to do a special Wealth Wednesday webinar where I'm going to go through actual clients and how they've used policies and the things they've used it for. And so I'd love to use you guys as some examples you guys are willing to share. But yeah, we're gonna go through real reasons why people have used this and how they use them, the results they got, all that kind of stuff. So keep in mind. All right, guys, appreciate everybody being here. Any questions, obviously reach out to me. If you guys want those PDFs, as I mentioned, go ahead and email me at brian@chrisnaugle.com and we can go through it. Kurt, is this system open and available in Canada? Yes, it is. Yes, it is. Yep. So I can go through it with you if you want. It's the same way. It's the same way. The only difference in Canada, by the way, is because it's a different country, the taxes are applied a bit differently. So in Canada, there is a different tax implication, but yeah, we have a counterpart that does these things in Canada for our clients. But yeah, I mean, it's life insurance companies up there do this still. So same way. Can I get a link from my family? Yes. So Kurt, send me an email at brian@chrisnaugle.com. And then what I will do is I will send you the link, the replay link to this. And also, if you go to Chris Naugle's YouTube channel, so go to YouTube and look up Chris Naugle and then subscribe to his YouTube channel. We post these about a week later inside there as well. And so we do this every week, by the way. Sometimes it's me, sometimes it might be Jason or Carson or whomever, but we do these every week. They're a little bit different sometimes because I do mine differently than, say, Jason does, but yeah, send me an email or go look in the YouTube channel. All right, guys. Well, with that, have a great rest of your week. Stay safe, and hopefully I'll talk to somebody here very soon. All right, appreciate y'all.
All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.